Today's content is really going to be about helping you learn how to manage some of these conversations and leverage some of these tools to offset and augment the conversations that you're already having with your clients, providing you more tools. Every solution starts with a problem. The problem that we have right now is a housing shortage and an affordability shortage in our country. And I'm not going to get into the details, but I do want to highlight a couple of things. One, we are not here to sell mortgage products. And I want to make sure that you, as advisors, should never be selling mortgage products. That is not your job. It is not our job. Our job is to help you present the information that you need so that your clients can make well-informed decisions. I think three things that you guys can guarantee you will take away from this conversation. Number one, you will have a basic understanding of how they work and when they are applicable. Two, you will have the lexicon to be able to speak to them and about them to overcome some of those initial objections. We will share a few ways and strategies to bring them up that don't necessarily run into the hard door stop, and we can share some stories about that, or at least I can share some stories about that. And then lastly, the plan of action. Like, plans are great, but actions are better. So we'll talk about like what are those next steps once you get past those initial conversations. Without going into the basics of a reverse mortgage, what it is and why it's an important topic, I'll hand that off to the experts. Literally, the man who wrote the book on home equity and retirement planning. Harlon is the National Director of Reverse Mortgages at Movement Mortgage, and he is our featured presenter today. He's the best speaker I've ever heard on the topic, so I'm really, really honored to have him here with us today.
Well, it's a niche. It's a niche market, so there's not that many speakers. So that makes me, really good at a small pool. So thank you. I was hoping you weren't going to say too many good things because then you'd expect me to be really good at it. But I do happen to be really good at reverse mortgage and retirement planning because that's all I've done for 20 years. Is work on housing wealth retirement planning, specifically with reverse mortgage, which is a relatively unpopular topic. To give you a little bit of a background, I have my own reverse mortgage. I'm 64, so I did mine 2 years ago, almost 3 years ago now. So here's the situation. Understand everything that I go over is not something to promote movement or even promote reverse mortgages. I've learned everything that I've learned from people that are a heck of a lot smarter than myself, which my wife always says, don't say that because that's kind of everybody. But the fact is I have dealt with some really smart people. One of them is Dr. Wade Pfau, that you may have heard of. He's done a lot of writing, a retirement researcher website, The Ultimate Nerd, PhD, CFA. He doesn't look at anything any other way than subjective. He's just agnostic about everything. Just let's look at the numbers. So I spent a lot of time with him, helped him with his last couple of books that he specifically worked on with reverse mortgage. The people at Texas Tech University kind of started doing this 10 years ago. Harold Davinsky and John Salter kind of started the initial running Monte Carlo simulations. Then Boston College for Retirement Research, University of Illinois, Jamie Hopkins, who's now in Philadelphia, used to be with Carson Wealth. So these are the people that I've learned these things from in challenging them, and why I got one myself, even though I didn't need it, of course, and fit the category of the client that you described. So this is really honed over hundreds of thousands of Monte Carlo simulations. The most important a general slide that I can show you is this one right here, which is really encapsulating all of the research in less than 5 minutes. Is everybody owns a home has 3 buckets of wealth. Bucket one is their ability to make income. They own a business. They're getting W-2 income, commissions, excuse me, whatever. Then bucket two is what you manage, the nest egg. That's everything from, in investments to stocks, bonds, insurance, annuities, whatever. And then bucket three is what Jason and I manage. And so Jason and the people that do forward mortgages, traditional mortgages, have done a fantastic job of creating wealth in bucket three. As of last month, $14 trillion is sitting in bucket three, totally unmanaged. It's the largest unmanaged asset in the world. There has never been that much money in one asset in the history of any country in the world. And so we've done a great job of helping people build wealth. We haven't done a great job of teaching them how to use it because a lot of loan officers don't talk to financial advisors. This is kind of an unusual thing that we're talking together because usually you guys talk to attorneys, we talk to realtors. And I spend most of my career in the last 15 years talking to financial advisors because that's really where the interaction between bucket two and bucket three is critically important and where the research has been done. So during your normal years in the top wallet, in the pre-retirement wallet, you're making a bunch of money. Most of it evaporates right off the top. You spend it on cost of living, food, clothes, cars, kids, whatever. But they try to give you somewhere between 5 and 20% of their money, depending upon how much they have. The national savings rate is only 5%. But people are trying to save as much as they can so they can retire, so they've got more money when they're older. But Jason and the people like him are incredibly demanding because they're your biggest competition. Jason asked for 29% of people's income on the first of the month on every month from the time they're 25 till they're 60, whenever they buy a house. So a tremendous amount of money from the cash flow flows into our numbers on the first of the month into home equity. So a lot from the down payments, monthly payments, the maintenance on the house, whatever, a tremendous amount of money flows into bucket three, which has created a lot of wealth. So when you go to the post-retirement wallet, and this is where the research started by people in your industry, I say, okay, well, income is going to go down because people are going to quit their job or they're going to work less or whatever, go to Social Security, pensions, maybe sell their business, whatever. And then they come to you and say, hey, Todd, hey, Emily, I gave you guys a bunch of money for the last 10, 20, 30 years. I want some of it back. And I want to go on a Viking River cruise and I want to give my kids some money and I want to help my grandkids go to college or whatever. And all of a sudden they want to pull a whole bunch of money out of bucket two. What's really strange is even though Jason was incredibly demanding and threatening to people that if you don't send me a third of your income every month, I will kick you out of your house. By the way, you should try that. It works really well. But even though we force them to put a bunch of money into bucket three, they do not come to us and say, I want some of your money back, my money back. I gave you a bunch of it. I want some of it back, which is really odd, but it's a cultural thing because people in my generation were raised by the greatest generation. My dad went through World War II. His parents lived through the Depression, ate large sandwiches, all the stories that I heard. And they were incredibly averse to debt. Get rid of debt because you could lose your house. We've all watched the movie It's a Wonderful Life, especially at Christmas time.
Harlan, I just saw this hit this morning, right? Oh, don't take on debt. Don't take on debt. It's the enemy. You live like debt free, right? I mean,
yes.
So I got you.
Yeah. So that's what we've been programmed to do. So it's cultural to get rid of your house mortgage and dump the money in and don't take any out and give it to our kids when we die. That's the sum total of the whole plan, which is weird.
Here's the finish line.
Yeah, that's the finish line. If you can have your house paid off and then give your house to your kids free and clear, well, that's just great. Unfortunately, the kids don't want it, and they promptly 90% plus sell it.
They sell it, go buy a big ass house, and mortgage their asses off.
That's exactly right. You got it down. So you saw the whole scenario, and what's weird is if I came to you and I said, hey, Todd, I gave you a whole bunch of money for the last 30 years. I'd like some of it back. And if you said to me, Harlan, that's not really your money. Just leave it sit here. And when you die, we'll give it to your kids. I would be pissed and I'd fire you. I'd say, no.
You'd probably go to prison too, to be honest with you.
Well, yeah, there's other problems. So, but that's what they do to us. They give us the money and then they just leave it sit. So what the research started doing is saying, hey, what if we start you're eligible for a reverse mortgage at 62. So what if we start taking money out of bucket three right away, as soon as you turn 62, even though you don't need it, let's start taking money out of bucket three because it's tax-free and it's money that can be of help on an overall basis to the overall retirement plan because there's a lot of money there. When they started doing that research, they found out that people that did that ended up, three things happened almost 100% of the time when they were running this in Money Guide Pro and eMoney and all their Monte Carlo simulations. Cash flow went up, obviously, because people were not making payments and they were taking money out of that asset. Secondly, they decreased their income taxes, which was kind of a nice little plus. I will save over $50,000 worth of taxes this year because I have a reverse mortgage. I'll save at least $250,000 on my mortgage if I live to be in my late 70s. But the third thing was the most surprising. They found out that people that took money out of their house in the beginning stages of retirement, as soon as they turn 62, actually increase their net worth and thus their legacy to their kids, either while they were alive or after they were dead. That was not expected because it was always assumed if you do a reverse mortgage, that's great for the old people, it screws the kids, and they will end up with a smaller inheritance. The opposite ended up being true, that yes, you will die, I will die because I have a reverse mortgage with less money in bucket 3, less equity in my house, but I will have a lot more in my nest egg because I gave more money to my advisor and less money to my house.
And I'll add to that. I always say we talk about retirement as a golden parachute. You hear about golden parachutes from CEOs and their retirement packages. But here's the thing with parachutes. They only work if you pull it soon enough. If you pull it too late, you go splat. So when used correctly, these reverse mortgages are an important part of the overall parachute. And we can talk a little bit about some of the tax strategies that I know Harlan's going to get into, because the reason that wealth goes up so much, Harlan, it's because you have the flexibility and freedom to do whatever you want with those funds during that time, correct? So if I want to gift those to my kids into their college funds or my grandkids into their college funds, if I want to give it to my advisor to invest in other income generating assets.
Yeah, the bottom line is that when they found out this whole idea that you can take like Wade Pfau's book is full of just 100 and some pages, just full of charts and graphs, and it's kind of boring actually. There's no stories in there, but the bottom line is that the more money that you put into bucket 2 as compared to bucket 3, the better your retirement and the better your outcome will be. And that was a surprise because it was assumed that people like me that are still working, that have plenty of money and have put money aside for the future, don't need a reverse mortgage. And it is true, I don't need a reverse mortgage, but that's not the issue. I don't need a financial advisor. I don't need a stock fund. I don't need a brokerage account, but I have one because it just makes sense. So it's not a question of need. So the vast majority of people, when this came out in 1988 under Reagan's term, because when my dad retired in 1981, there was no reverse mortgage. He eventually got one because I understood where the value was for him. But when he retired in 81, it didn't exist. In 1988, during Reagan's term, that's when they came out with the reverse mortgage. And at that point, everything changed because now I can safely take money out of bucket 3 without endangering my ability to live in the house and get kicked out of the house, like happened in It's a Wonderful Life, where the evil banker kicked people out and called the loans. These loans cannot be called. They are non-recourse loans. They are guaranteed that all money coming from a reverse mortgage, it never has to be paid back by the person that's borrowing it. I signed a form when I did my reverse mortgage, as everybody does, release of personal liability. I'm not liable for it. My wife's not liable for it. My kids aren't liable for it. The house is liable for it. And if the house doesn't have enough money at the end, FHA is liable for it. So I do not have to make that payment ever unless I want to for tax purposes or whatever the situation is.
May I ask a quick question, Harlan?
Yes, go ahead.
Because I think that's where some of the language can get confusing for a lot of end users. The idea, so when you say I'm not liable for it, the bank doesn't own my house any more than the bank owns my personal house because I have a mortgage, correct?
That's correct. It's just a loan. It's just a loan that has a very different repayment structure. Your loan requires you to send in a payment every 30 days. My loan requires me to send the payment in whenever I want, but for sure when I permanently move out of the house, when I die or sell it or go to a nursing home or whatever, which is a fundamental difference. So there is no ownership change. And thanks for clarifying that, because a lot of people think that I've sold my house to the bank. That would trigger capital gains issues, everything else. That's why everything coming out is tax-free, because it's a mortgage. It's borrowed money. It is not selling the house. There is no transfer of ownership. I own the house, or my trust owns the house. My kids own the house after I'm dead. So that is something that is critical to understand, that you're simply using some of the money. How much of the money can I use? Depends on my age and the current interest rate. About 40% at 62, 70% at 92. So what happens is you have to qualify for a reverse mortgage. The first thing is you got to be old enough. So I had to get to my 62nd birthday, or you have to be married to somebody who's over 62. My wife is underage, not under 18, under 62.
I will say this, selling tip. They love when you say that in a meeting, that they are an underage spouse. It's a big hit. It always gets a good laugh.
Yes. So my wife was 59, so she's able to participate in it also. So if I die tomorrow, she can stay in the house and enjoy the reverse mortgage for the rest of her life. So that's the first thing is you got to qualify by age. The second thing is you have to have enough income to pay for your taxes and your insurance and whatever other obligations you have. So there's manual underwriting to make sure, because if you're in New Jersey, for example, and you have a $25,000 tax payment, well, maybe you don't have enough income to justify that. Maybe you should move somewhere because you can't afford to pay the taxes. So we want to make sure you can afford to pay the taxes because it's the only way you can get foreclosed on. So a reverse mortgage, you have to live in the house and you have to pay the taxes and insurance. That's the only requirements to perform under the loan. There's no payment involved.
That income come from the mortgage itself. So
Yes.
say like I get $2,000 a month from my reverse mortgage and my taxes and insurance are 500. Is that sufficient income proof?
Yes, that would be one of the examples. Some people just take out a reverse mortgage simply to pay the taxes, maintenance, and insurance because they can do everything else and they can truly live for free. Excellent point. Because that's now that becomes income, not taxable income, but it becomes usable income. Never gets reported on the return. Then I go through that, I qualify. Okay, I qualify for 40%. So in my case, my house was $1 million. So you qualify for $400,000. So how do I get that money? Well, I can either take it out in a line of credit, because if I have my house paid off, which I didn't, I'll get to that in a minute. But if I had my house paid off, then I set up a $400,000 line of credit. You say, well, that's no big deal. You could get a bigger line of credit anywhere. Well, this line of credit is very different in 3 ways. Number one, this line of credit is guaranteed never to be called. Any other line of credit can be called. Because if the value of your house goes down, you become non-credit worthy, whatever, that line of credit can be shut off and called in its entirety whenever the bank deems itself insecure. A reverse mortgage line of credit can never be called. It is guaranteed to be there no matter what, as long as you live there and pay the taxes and insurance. The second thing that's very different about this line of credit is it grows. So when it comes to financial planning, this is one thing that really fired up Wade Fowle about this whole thing, is this is a guaranteed growing line of credit. So if I started at 62, I don't need the money. It goes up by whatever the rate of interest is at 7, which is currently about 6-7%. Goes up every year. So if I've got a $400,000 line of credit, next year it's 430, the year after that it's 460, and so on and so forth. It just keeps going up. This is a great way to plan for future income needs when you don't need it now. Long-term care issues, people that can't afford or can't qualify for a long-term care policy, set this up and use your house as a long-term care insurance policy. It can be used for mitigating sequence of returns risks. That's one of the research that was done by Texas Tech University, has said, hey, you can keep more money invested. You don't have to put his money in bonds. Keep 90% or more in stocks, because whenever the market goes down, you can pull from the reverse mortgage. Whole bunch of things that will affect everything you do in your financial planning of bucket 2, if you know that there is another tax-free source of money that is guaranteed to be drawn from whenever you want it in the future. So this is a very common thing. When people don't need the money is usually the best time to borrow it. So they set up the borrowing. There's no cost other than the closing costs. There's no annual fee or anything else. You pay the closing costs, and then that line of credit is guaranteed to continue to grow. The second way that you get money, I'm sorry, go ahead.
No, go ahead, because I'll follow up with a question after.
Do you have an idea, I mean, just kind of a ballpark number of like what the closing costs usually run as maybe a percentage of the loan?
It's always a percentage of the value of the house.
Okay.
So let's look at it this way. The closing costs are the same as any other forward mortgage, except for one thing that makes it more expensive. And this is one of the things that I want to that I cover right away on this page. First thing is everybody thinks a reverse mortgage is super expensive, which in one way, excuse me, it can be. There's costs just like any other mortgage, appraisals, titles, all that sort of thing. But there's one thing that's different, and that's a 2% fee that is like buying a put on the future value of your home equity. It's insurance. It's FHA mortgage insurance. So I had to pay to get my reverse mortgage 2% of $1 million, or about $20,000, to put this loan in place. Now, I didn't pay it. That's taken out of equity, which to me is kind of like paying it with beads, because it's not real money, it's equity. And it's just subtracted from the amount of what I got from the loan proceeds. So I got less from the loan proceeds.
Now, let me make one clarification, because this is a pro tip when having the conversation. One thing this is a quick story. So I had a realtor I did this presentation with, and he immediately walked out of the doors, called his mom and said, "Mom, I know you've been struggling. You've been going through cancer treatments. We've been trying to tell you you have to sell the house. I have the perfect answer. You're going to get a reverse mortgage." And she hung up on him and swore him out and said, "My kids are never telling me what to do, and you don't know anything." The key to, in my opinion, to having some of these initial conversations with clients is in the phrasing, because you don't want to poison pill it with the word reverse mortgage. I'm not saying mislead people, but this gets back to that insurance policy. Just like that upfront mortgage insurance is there on any government loan. So a VA loan has an upfront funding fee. It's financed into the loan, just like a reverse mortgage. An FHA loan has an upfront funding fee. It's financed into the loan, just like a reverse mortgage. Any government loan is going to have a similar structure. The pricing varies a little bit from loan to loan, just like it would from borrower to borrower if the borrower was securitizing the house. So whenever we have these conversations with people, I will often say, just as there are VA loans for veterans, just as there are first-time homebuyer loans for first-time homebuyers, there are payment deferred loans for retirees over the age of 62 that can help offset your cash flow. And simply using that line can open up the doors to the conversation much faster or more openly and warmly than saying, "Hey, I think we should consider a reverse mortgage."
Yeah, there's no question. So that 2% goes to FHA to guarantee when there's a decrease in values, when you live too long, when the home value dips, whatever the situation is. It guarantees three things: you never have to make a payment. It doesn't matter what the value of the house is if it goes down, and your line of credit will continue to go up even if the value of your house drops. So that's why it's like buying a put on home equity. You're guaranteeing a future value no matter what. Now, is that expensive? Well, anytime that we take a look at a client, if somebody's only going to be in the house for 1 or 2 years, a reverse mortgage isn't a great idea. If they're going to be in for 3 or 4 to 5 years at least, then it makes sense. For example, I'm in my third year, and I'm going to save somewhere between $30,000 and $40,000 in taxes this year. That more than wipes out the costs that I gave up on the mortgage 3 years ago. So we have to make sure, and that does not include the fact that I didn't have to make a payment for 3 years, but I also get the tax benefit, and I'll show you that in a minute.
Do you have to bring any money to closing or anything?
Not unless you have too big of a mortgage. So if I owed $500,000, I'm eligible for 480, then I got to bring cash to close to pay down my balance so that I can qualify, because the loan to value will not go up. So if I owe 500 grand and I only am going to qualify for 480, I have to have a lower amount, and so then I would have to bring cash to close. Sometimes it doesn't make sense to wait, because you can accomplish more by doing it right now, and you're better off putting money in, because like my payment was $37,000 a year. So if I can save $37,000 a year, and I'd have to bring 60 grand, big deal. That's only 2 years worth of payments, and I'm done making payments for the rest of my life. So it depends. It really comes down, all of it comes down to math. The second scenario, which is the least used scenario, is a monthly check. Everybody thinks that's the main reason that you do this, to get a monthly check. We can guarantee a monthly check, and kind of like an annuity, we just set up and say, okay, we'll give you $2,000 a month for the rest of your life. If you only want it for 10 years, we'll do it for $2,500. If you only want it for 5 years, you get $3,500, whatever. To Todd's question from earlier, it depends on how long you want the payment. I was talking to a son of a borrower in Green Bay a number of years ago, and he said, he said, "Harlon, I think my mom's defrauding the government. I don't know exactly what to do. She gets these checks for $3,000 a month, and she's upside down in her house. I know her house is only worth 400 grand, and she already owes 500, and she's 93 years old, and she keeps getting these checks, and she keeps cashing them. Is that not going to be a problem, or am I in trouble?" And I said, "No, that's not a problem. Tell her to keep cashing her checks and keep living, because she won the game. She's getting more out than what the house is worth, and she will continue to get those $3,000 checks until she dies, and then you'll be able to take a tax deduction on the interest that she never paid." Needless to say, as soon as he understood that, he did his own reverse mortgage on his house, because he was over 62. She's obviously in her 90s. She died being about $150,000 upside down in her house in about 2012, when the market was bad, and he paid nothing and got the tax deduction. So that's what that guarantee does. Is it guarantees that you're always going to get the income, that you never have to make a payment, and if you're upside down at the end, FHA pays it, not the client, not the heirs.
And
So
that's what that PMI policy does. Now, Harlan, can you walk us through how that works in the conversation with the heirs? So that exact conversation. So if I'm that son, my mom passes away, I now own a house in this estate that is worth 400, but I owe a $500,000 mortgage. What does that process look like? What are the steps? And why should I not be worried?
Yeah. So the fact that he's upside down, remember the 2% guarantees that there's no personal liability. So unlike regular mortgage insurance that you're familiar with, mortgage insurance always protects the lender. This mortgage insurance protects the lender, but it also protects the borrower and protects the heirs, which other mortgage insurance does not. So the heirs are protected. So we will go to them and say you have two options. You can refinance the loan and buy it out for 95% of the new value, which is 400,000. So for $380,000, you can refinance that amount and keep the house. Or you can sell the house for $380,000, get nothing, but get a tax deduction. And so, or if you want to sell the house to someone else, a family member, a grandkid wants to move in, whatever, they have the same option. So it guarantees that if they want to keep the house, they can. If they don't want to keep the house, they're still going to get the tax deduction on the interest that mom and dad never paid. Dr. Barry Sachs, who I've worked with, a tax attorney out of California that has written on reverse mortgages, has his own reverse mortgage, wrote an article called The Lost Deductions. A lot of kids lose the tax deduction on reverse mortgages because they didn't know it existed. So that's a very significant issue.
What happens if the home appreciates? So if it goes in the opposite direction, so for example, home's worth $1 million, you have a reverse mortgage for 400,000, you're passing, the home's worth 1.5 million or something like that. How does that situation play out?
Yeah, so if it's good, the money all goes to the kids. So if I died, and usually, Todd, that's the way it is. There's almost always money left. Very rarely is the house upside down unless you die in a year like 2008 to 2012 when the values were depressed. Or if somebody lives into their 90s, most of the interest on a reverse mortgage is with compound interest is paid at the end, the last 10 years, after you hit 87. So in that situation, if the house went up and a house was worth 1.5 and we owed 500,000, the kids sell the house for 1.5, pay back the 500,000 and split up the million. So if it's good, the money goes to the children, whoever the heirs are. If it's bad, the bill goes to FHA.
Todd, and if they wanted to keep the house, for example, they would have to refi the 500,000 loan or something.
And if it's over, they would just need to pay off the balance of that loan, just like they would on a traditional mortgage.
They could use a brokerage account. There might be a life insurance, or they could. We're going to go to them and ask the forward mortgage person, Jason, to refinance the loan and keep it. It just makes sense to continue to leverage it. Maybe even get some cash out to fix it up.
So talk to me. So talk to me. I mean, these all seem like good, advantageous ways to do this. Where does this go wrong, right? Like, where do we see the issues arise? Like, some kid thought they were going to get the house and is now pissed off that there's a mortgage and they thought they were going to cash it in for more than they were. Where does this kind of go wrong, and where does it become a problem?
Yeah.
Reputation starts to flow from.
Yeah, as you can imagine, at this point, when we're explaining this, people say, well, that all sounds great. That sounds a lot better than what I thought. This sounds too good to be true. And I always say the same thing. It's not too good to be true. It's too good to be free. That's why there's this 2% fee. 20 grand is a lot of money that I have to pay in my house. So you're paying for this, but there's only two ways that this can go wrong. Number one is you don't have the ability to pay taxes and insurance. And if you don't, it's going to be a problem. You're going to get kicked out of your house when you're 85 because you can't pay taxes anymore. And that's going to be ugly and it's not going to look good. And it'll probably make the pages of the paper because kick a young person out, that's okay. Kick an 85-year-old guy out, and that doesn't look good. So we hate those kind of things and we try to avoid them completely. But that's where it can go wrong. If somebody dies, something goes wrong, and you can no longer pay the taxes and insurance, and the house gets foreclosed on. The second way that it goes wrong is if you don't understand it and your family doesn't understand it. I want to talk to you and your wife and your kids before we do this. And in addition to that, your trusted advisors. I want to talk to your financial advisor, your CPA or attorney, if they're the ones that are making the decision. And I don't want to make this decision in a vacuum because what I do affects what your financial advisor is going to do. And if you don't understand how this goes together, like I just talked to a client yesterday who got a reverse mortgage from somebody else, and she had just pulled out $80,000 out of her IRA. And she called up about potentially refinancing, which it didn't make sense to refinance because of where she was at. But I said, have you made any payments on this thing? And she said, well, no, I don't want to make any payments. And I said, you did this IRA distribution. You got another IRA distribution coming. Did you know that you can save 15 grand? And she said, they never told me that. I had no idea. So the problem is when people are not properly educated and they don't understand how these things work, it can be something that is a problem. Those are the only two. Believe me, I've been doing this for 20 years. That is the only two things when the kids get pissed at the end because they don't understand what's going on or the client doesn't understand. We hate doing these loans without a financial advisor involved.
I would add that it comes down to communication. Like anything else, it's going to come down to communication. There are, and Harlan might be able to correct me on this, but 200-ish licensed reverse specialists in this country. So technically, you could walk into a bank and you talk to some teller and you start the process of getting a reverse mortgage. The problem is the person you're actually working with is not the licensed specialist that's having this conversation. And I think this is one of the things that's unique about the process here at Movement, and other places that do it correctly, is that the communication starts with me and that I can help kind of figure out, is this a viable solution? But very, very, very early on in that process, I will include, in my case, Lynn Coffin, who is my reverse mortgage specialist on my team. I would rather have Harlan and his team and Lynn have these nuanced conversations and handle it as someone who only focuses on this product, because they are nuanced loans that require a bit of hand holding. And when they are mishandled at the very beginning and that communication line falls down, they will fall apart. And I've seen it time and time again. And that is one thing that we do very early on, is involve all the parties, all the advisors, all the heirs. They have to go through counseling before we even get involved in these conversations.
Basically, what it comes down to is, how many people does this work for? It works for the vast majority of people if it's understood what the purpose is and what it's going to be used for. And so there is way more people that should be doing that are not doing it because of that. So there's the third way to access the equity is lump sum. And that's the way I did it because I paid off an existing mortgage. By far, your client that can be helped the most will be using the lump sum option. They're currently paying a mortgage. I had a $450,000 mortgage that I was paying, a $3,000 a month payment. So I could afford to make that payment, but I used the reverse mortgage to refinance the forward mortgage into the reverse mortgage so that my payment went to zero to optional. When I did that, I sent that $3,500 a month to my advisor instead of sending it to the mortgage. So over the last 3 years, I have lost accrued $90,000 in interest. But the $3,500 that went to my advisor, some of that money went into a crazy little stock that I had no idea what he was talking about called NVIDIA, which happened to do pretty well. And so in that process, the money that I've got in my brokerage account far exceeds the $90,000 that I lost because I've got all the money that I did not make in payments to my mortgage. In addition, this year, I'll get a tax deduction close to $40,000 by making a payment. So that's where my net worth went up. I lost $90,000 in equity. I gained over $200,000 between taxes and my other investments. So the lump sum, the people that are
Harlan, let me take a step back there. So you had a $400,000 mortgage, whatever it was, whatever you did a lump sum reverse mortgage. You were able to then pay off the forward mortgage, right?
Yep.
So now all you have is outstanding. You have this outstanding.
And I got no cash, Todd. I got nothing out. I just got money to pay off my mortgage.
I understand. So essentially your positive cash flow is the fact that you don't have to make a payment anymore on your mortgage, right? So that's your net positive cash flow. So now you have this reverse mortgage sitting out there. That's this lump sum, right, of $400,000. Let's call it what it is, a round number. So now you don't have to make any more payments on this for the rest of your life, or are you required to make any kind of payments whatsoever?
Never. But I make payments occasionally to get a tax deduction, but I don't have to. If I didn't want to,
For example, what you're doing, if you choose to do so, you can make the interest payments,
Mhm.
right, on the reverse mortgage and take the tax deduction for the interest payments. And by doing that, you're keeping that out of your estate at the end, essentially, so that when your children or whatever can sell your house, there's less of a liability at all. But somebody could just accrue that.
Absolutely. And quite frankly, that's what I'll do, because as soon as I make a payment in my reverse mortgage, I pull it back out and put it back to work, because I don't want a bunch of equity sitting in my house. My goal is not to die with the most equity. My goal is to have the highest net worth and spend as much money as I can on my kids and my grandkids. Yeah. So there's three types of people that are going to do a reverse mortgage. The first group are the people that have their house paid off, and that we're going to treat very differently than the people that have a mortgage payment. So all of your clients that have their house paid off, they should set up a line of credit so they have money access and available to them right away. Then the first people that you should work with are the roughly 40% that I started talking about originally of your, which is probably somewhere in the neighborhood of 100 people at least, that are making a mortgage payment and they don't need to anymore. They should redirect that asset, that cash flow, to bucket two. The third group of people are in the wrong home. It's either too big or too small, or it's not in the right location, and they need to sell it and go somewhere else. Now, in the process of what Jason was just getting to, is I can choose whenever I want. If you think back to this diagram, my goal is not to die with the most money in bucket three, and whatever I have left, I want to go to my kids. My goal, I do reverse mortgage vacations. I help the kids and the grandkids out whenever I can. We pay for all the vacations, all the trips that the kids take to come see us in our condo in Florida. And in any situation, I'm going to give with a warm hand instead of a cold hand, so that I don't have to just amass all this money that when I'm 90 and they're 60. So you can see, if this keeps going up, by the time I'm 100 years old, I'll owe 2.6 million. So I started out at 444,000. You see the loan balance column in the middle. By the time I'm 80, it'll be $1 million, so almost more than double. By the time I'm 90, it's 1.5, 1.6 million.
Harlan, you have access to this capital.
No, I don't have access to it. I have line of credit because I ran all of this up because I'm not making payments.
Okay.
So I made zero payments. If this was a line of credit and my house was paid off, this would be the line of credit column, and that's the access that I would have to that money. It would look exactly the same because they're both using exactly the same factor. It's no different from that perspective.
I got you. Line of credit, you're not drawing on the money, so they're paying you the interest instead of you accruing the interest.
That's correct. Exactly correct. So it'll work for me. So if I've got the house paid off and I don't need the money, get the line of credit on there and let it grow. And then I can use that money that when I'm 80, I've got an extra $1 million to spend. So if you have your house paid off, that's group one. They're going to handle things slightly different.
It's an insurance policy. And if you never use it, there's nothing to pay back, right?
That's right. Then you die, and whatever the value of the house is, and you can see over here is the value of the house. The value of my house is, there's the property value going up. So when I turn 80, my property is worth $2 million and I owe $1 million. Still $1 million worth of equity left. And so when I turn 100, which is unlikely, house is $5 million, you owe about $3 million, the kids get $2 million. So at any given time, this is the equity column over here and of what's left. Now, if my house is not worth $3 million at the end, that's where the forgiveness comes in with no tax consequences, and I don't have to worry about paying it. So there is 50 different ways to use a reverse mortgage as to how it fits in, just like there's 50 different ways to use IRA money. You can use it to help kids. You can use it for donating money. You can use it for traveling, whatever the situation is. Same thing. You just want to look at bucket three the same as you look at bucket two. But for this to make sense to you, this will give you an understanding that reverse mortgages are not bad. They're good, and they work better for people with money that have over $1 million than they do for people that don't have any money. Yes, we can help the poor little widow lady who is broke at 85 years old, and we want to help. But if we do the planning beforehand for the 62-year-olds instead of the 92-year-olds, we can make a difference in virtually every situation to make their retirement more efficient, where they're paying less taxes. So what we'll do is we'll send you Jason will send you over a just a quick little fact sheet. Do not give us any personal information, but give us 3 or 4 or 5 examples of clients that you have that you don't know if we can help them or not. But based on what I've said, maybe we can. And show what they have for home value, what they owe on their current mortgage, and try to pick at least 3 or 4 people that have mortgages, because that's where definitely the biggest change is going to be, where we're refinancing. They got 50, 60, 70% equity, but they're in a situation where they're still making mortgage payments. And then we'll go through, don't give us their names or anything else. We're just looking at case studies. And then we'll come back in a week and say, okay, I just had this one up in New York. So this client is client PE, and they're 68 and 75. They've got $1 million in qualified funds, another 200,000 in liquid assets. They got a $500,000 house, and they owe $50,000. What can you do for that client? So any of those scenarios, that's all we need. And then I'll usually in 1 hour, we can get through 3 of the case studies, and then it will click. When I was talking to these folks yesterday, it was our second meeting in New York with them. I was going through, and it's like, oh, okay, that makes sense. I didn't realize that. And then we have actual scenarios like this of what the projection would look like at 70, at 80, at 90, and so on and so forth. That's the thing that really makes the difference. That makes it much easier to understand how that works.
I have a family member. She's well into her 80s, has a very nice house, all that kind of stuff, but it's in disrepair and getting worse by the second. And she's just like, I'm old. I don't want to fix it. I'm not gonna, like, it has foundation problems. Like, what would you need to see, like, leading up to, I mean, she can't even, if somebody bought it today, they would have to fix everything before they could even get a mortgage anyway. So it is absolutely cannot get a mortgage on it because it has foundation problems. So would you have to remedy like anything before you could do a reverse mortgage if it was previously paid off?
Well, it depends. We've run into some of those situations. In fact, I'm working on one of those in Rhode Island right now, where it's an 85-year-old, and she's bedridden, has got to have care, and she doesn't want to leave her house. And so the reverse mortgage is going to be used to pay for her care. She's got about $50,000 worth of deferred repair that needs to be done. Among them, things like the deck has not been stained or reinforced in about 20 years. And if you leaned against the railing, you would fall off. So kind of a safety issue. And so those things it's a standard FHA appraisal, which is no different than a forward FHA appraisal. Peeling paint, things that are going to cause it to just decay a lot faster. So
Structural, not cosmetic. I don't care about the paint, but as long as the freaking porch holds up and I don't fall off.
Yeah. And we don't care if there's holes worth through the carpet or whatever. We're not, concerned about the green tubs or the green sinks. There's $50,000 worth of things that need to be done to bring it up to code and up to FHA standards. So that money is going to be escrowed. And then we've already got her nephew is a contractor. We already got a contractor's quote. And so we're going to do the reverse mortgage. And then over the next 6 months, the work is going to be done. Some of it's weather related, some of it isn't.
Okay. So it is something that has to be remedied before you could go through with the paperwork.
No, we do the paperwork. We'll just give her the money.
Just on tap to do it.
Yeah, and then we'll just set up a credit line that's set aside just for that repair work. If it is an extreme safety issue, like the wiring is going to start the house on fire, then it's got to be done beforehand. But if it's not a safety issue and it's just things that are going to cause the house to decay faster, then that changes, and we're going to specifically have those things done over the time period.
Okay. Yeah, I was just wondering, like, say you get the reverse mortgage started and everything goes through, and then like a year later they start having foundation problems. Are they under any kind of like responsibility to report that or repair that? Are there any like riders to say that I'm going to do my best to keep the house in good condition or anything like that?
No, there's a standard clause in every mortgage, forward, reverse, VA, FHA, that says you are required to preserve and maintain the property.
Okay.
That's also in our mortgages. Do we ever come in and do an inspection afterwards? No. So we do not require any, hey, now you got to replace the carpet. Somebody said, I don't want the government telling me when I can replace the carpet. And I said, yeah, we don't want to do that either. We don't do that. We don't care if you have green carpet or red carpet or shag or otherwise. So nothing happens with the inspection after we've set the original scenario up, which is why we'll ask for things like the deck to be stained if it's fallen apart. Because
I was just curious if the house has significant depreciation, like it's just not worth as much as it would have been otherwise had they maintained it.
That can certainly happen, but that's what those protections, that's what you're paying for in the protection of the PMI, is so that when you go to dissolve the estate or sell the house or buy the house and assume ownership, again, that protection is going to ensure 95% of the appraised value. So in a situation like that, where maybe there's a foundational issue and a realtor comes in and says, look, I know mom said this house is worth 700,000 because all the neighbors' houses are worth 700,000. She hasn't kept the house up. I can't sell this for more than 500. Well, then that becomes the market value. And now you can set the price at 95% of that appraised value.
Okay. No, that was my main question. It's just
like
shit happens.
Yeah. So I'm from Tampa, and I have a little bit of a case down here with a client that may be suitable, may not be. There seems to be, we seem to be getting these hurricanes pretty frequently, right? So I was just wondering what the catastrophe provisions are and some of, with that insurance. Emily, you mentioned, if there's issues with the foundation, that seems relatively standard, right? Around here, we're starting to get every couple years, houses are getting pummeled by storms, and they get, they could go down 50% in value because half the house isn't there anymore. So what does that look like if there were to be like a death event and that were to happen around a similar time frame? Would that insurance cover, let's say, a catastrophe? Like, is there a catastrophe call in there for that, for that policy, or what?
Yeah, I'm pretty familiar with that because I happen to have a condo on Clearwater Beach, which is kind of a barrier island.
Yeah, you're pretty close to me. I'm
Yeah.
right next to the bridge is where I live. So.
Oh, wow. Yeah, I can see it from our place when we get down there. So the issue is that we require, flood insurance and homeowners insurance on every property that is in a flood zone. So the mortgage insurance is not going to cover that. The mortgage insurance is going to cover a drop in value or something that's uninsured that didn't get done or whatever the situation is. But if there would be a scenario like that, most people rebuild. If they don't want to rebuild, obviously they take the insurance money and pay us off and move on. But most of the time they're going to rebuild, and sometimes we put the new reverse mortgage on and it's worth more. I had a client that had the house destroyed by fire, and by the time they built the new house, it was worth more and we could give them more money. So the mortgage insurance covers drops in the market, but we do require full replacement insurance on every property that we do because that's our primary ability, because we cannot go to the client for repayment. They can have $2 million, $10 million in other assets. We can't go to that. We can only go to the house.
Okay. So there would be no opportunity or no reasonable opportunity. Let's say there's a death event around the time of a storm. I know of 3 or 4 different people that died in the last hurricane. And for those people, a couple of them died in the house. So let's say one of those people, something happens, one of them stepped in something, got zapped, the other person, their house burned down. So for one of those cases, let's say, something like that were to happen, what would the insurance situation be if, maybe it wasn't covered by some of those other policies? How would that impact the reverse later on? I know I'm getting really into the weeds here, but this is stuff I see every couple of years, so I've got to bring it up.
Yeah, no, it's very important. I mean, we've dealt with wildfires in California. That's a big deal. We had clients that got wiped out. Literally, even their dirt was wiped out in North Carolina because the river
was bad.
Went somewhere else. So when that happens, and if, remember, this is a non-recourse loan, promised in writing. So if insurance doesn't cover everything, it's our job to fight with the insurance company. And we will definitely go after the insurance company because we required flood insurance and we required homeowners insurance, rather regular hazard insurance. So if we will fight with the insurance company, but in no case we'll contact, the person died, we'll contact their kids or whoever the responsible party is and say, hey, okay, here's the deal. We got this much of a mortgage amount on it. And right now they owe 600,000. The house is worth kind of nothing because it's been wiped out. But it looks like you had it insured for 800,000. We're going to go after that 800,000, but we might not get it. If we don't, you won't owe anything, but you don't get anything either because it got all, burned up in the hurricane.
And this is an important distinction between, again, working with a licensed reverse specialist to get a real reverse mortgage. The question earlier, why did these get a bad rap? Where do some of the misnomers come in? I had an attorney call me the other day because she was working on a closing for a, air quotes that you can't see, I'm making, a reverse mortgage. We read through it. It was not a reverse mortgage. It was a private investor. And Harlan, can you speak to some of the confusion and why that is different? And the fact that I guess just where those tripping points come up, because that is a difference, Alex, in the question that you're asking would be handled differently and what people might call a reverse mortgage, but is not a reverse mortgage. And unfortunately, in a market like this, you're going to see more of these types of investors trying to help, air quotes again, people get equity out of their home.
Yeah, there's companies like Unison, Knock, relatively large companies that are not. There's a lot of lawsuits right now because they bring them out as reverse mortgages, but they're not. They're really they're called shared equity loans. And shared equity sounds nice because you're sharing an equity. Positive words sounds nicer than reverse mortgage, but a shared equity loan means they own part of your house, and sometimes you have to pay rent on the house. If you get to a certain point in the equity, sometimes you get kicked out of the house within a 10-year period. If you're not dead, that's a problem because now you're homeless. So a lot of issues on that. The only thing that we work on is non-recourse loans like the home equity conversion mortgage. And so whether there is totally non-recourse, if it was not done correctly, Alex, there is, and it wasn't non-recourse, it would allow the heirs to come after the lender to come after the heirs. And it would not be non-recourse. So whatever kind of reverse mortgage, if you guys don't want to have any problems, which obviously you don't, as you're putting everything together, they need to understand that they are absolutely guaranteed that they will never have to make a payment. They'll never be upside down and their heirs will never owe any money. And that is 100% that we can put into writing, even if a hurricane comes, and two of them at a time. My neighbors, I'm fortunately on the second floor. All my neighbors were wiped out on the first floor with the flood surge. And anybody that was not properly insured and anybody that had a reverse mortgage that didn't count was definitely not in a good shape. So very important point that you brought up there, Alex.
Yeah, I've had a lot of
question
people lose
about
their homes. Yeah, what do you got, Emily? Sorry.
no insurance. A lot of insurance agencies are pulling out of California, Louisiana, Florida, North Carolina, maybe. What happens when the insurer of last resort is more than what your client can pay?
Yeah, there's something called forced place insurance, which you're familiar with in the mortgage industry. If you don't have insurance, we can put insurance on it. And quite frankly, there's some people that couldn't get insurance that are paying us the forced place insurance, and they're saying thank you very much because we can get insurance.
Anything's better than nothing. Some states don't. I mean, like there are literally, it is the state that is the main insurer of everybody, like Florida and California.
Exactly.
There's nobody else in their markets anymore.
We're very familiar with that. That's a very big deal to us. And there's, quite frankly, that's one of the reasons why some people get a reverse mortgage, because they know their taxes and insurance are going to be covered, because they're going to use the equity to cover it so they can live in their house. And because it happens to be really nice when the weather's nice, it happens to be really nice in Clearwater Beach. It's just that a few times of the year, it's just not very nice. And that's when you really don't want to be there. So that's really the issue. But yes, we're very aware of insurance. In fact, Movement has their own insurance company, our own PNC company, that makes sure that if people can't find their own, we don't force them to use our insurance, but many people do because it just simply makes sense.
Okay. Are you, I mean, like, are you kind of in the same ballpark as like the insurer of last resort as far as pricing, or are you just in the
No,
market trying to be competitive?
no, we're competitive. I've got a building, commercial building in Wisconsin, and I insured it through Movement Insurance, and it was cheaper than my local State Farm agent. So,
Yep.
but if
And
it's
we use it on our forward mortgages a lot too. We offer it as an option. It's actually a nonprofit arm of Movement, so any proceeds from it will actually be donated back to the foundations and charities within the local networks and everything. I think part of the takeaway from today's conversation, because we're starting to get into the weeds, and I'm happy to continue doing this because I'll put it this way: I was golfing a couple of months ago, and I was doing horribly, and I'm not a good golfer, but I was doing really poorly, and even for me. And all of a sudden, the topic of reverse mortgages came up, and it was like birdie, birdie. And I was like, oh, all I had to do was start talking about reverse mortgages, stop thinking about my golf game, and all of a sudden, I was a good golfer again. And so I love talking about this, but you and your takeaways of your team, you are financial advisors, you are not mortgage lenders. We do not expect you to get into the weeds on the details. What we want to make sure that we do is, again, arm you with the tools to start the conversations and have the warm handoff to a professional like myself or Harlan in particular, so that you can have well-informed clients come back to you and make a well-informed decision with all the data. So again, like some of the key phrases, Harlan, that you know are successful, and ways that people as advisors can have and manage these conversations. I mentioned the one about first-time home buyer loans for first-time home buyers, VA loans for veterans, specific income deferred payment loans for retirees. Are there other tips and conversation things that you would add to help people manage these conversations?
Yeah, most of the time we have a 5-step process. So what we do is step one is for you simply to identify that somebody is over 62. You have no idea whether or not we can help them. You think that we might be able to help them because of the stuff that we talked about today. So you just give us a case study sheet with, again, no personal information. Step two, we analyze that and go through it after we get this little form here, which is just the intake form of the 3 buckets. Then we analyze it in step two and say, hey, it worked for this. This will decrease their tax bill. This will help them with Medicare IRMA. This is going to be something that's going to make their money last longer. And then step three, we have a discussion with you. And we go into what their goals are. Like this particular client's goals, the client's in year 2 of a Roth conversion strategy, 250,000 in Roth, 750,000 remaining traditional. This year's conversion will be paid for by a severance check in early 2025, but they need additional funds to continue converting into 2026. And eventually in 10 years, they want to move closer to family in Texas after the husband retires. So once we get that information, we go back and forth with you in step three, then we understand, hey, this is what we're going to be able to do. We're going to take care of the Roth conversion. We're going to be able to decrease their taxes overall, and we're going to be able to make sure that they have enough money to put down on the house in Texas when they move in 10 years or whatever the situation is. When you then go back to the client in step four, hey, I've got an idea for some solutions. We can save you some money on taxes. It's not about the mortgage. It's about the fact they're going to save money on taxes. So you don't sell people a product. You sell people a retirement plan, and you're going to be able to do this. You're going to be able to enjoy life doing this. And so what you want to do is virtually every client, just make us part of your planning process. We're an unpaid expert on housing equity. And whether it's a forward mortgage that Jason does or a reverse mortgage that Lynn and our team doesn't make any difference. We're just helping you be able to put a better situation together for the client, because let's be aware that $14 trillion is unmanaged. I was doing a speech in Atlanta last year, and I said, yeah, our company is Movement Mortgage, and we have $10 trillion of assets under management. And I know the guys at Vanguard have 2 trillion, but we got 10 trillion. And their heads kind of snap, and who is this guy? I mean, we never heard of Movement Mortgage. How can they have 10 trillion of assets under management? So what we're doing is just figuring out how to manage those assets. And that's the way that you're going to work with us from that perspective, is just say, hey, how can you help these people? What would you do? So you should do it with everybody over 62. And even the people that are in their 40s like me, when I knew that I was going to do a reverse mortgage at 62, my house was not paid off by design, not by accident. I gave all of that money to my advisor instead of paying off my house because I knew when 2022 rolled around, I was doing a reverse mortgage.
Mhm.
So it started with my forward mortgage when I refinanced from a 15 to a 30 and said, okay, I saved $1,500 a month. Now I can give $1,500 a month to my advisor. I know I'm not going to be out of debt by the time I'm 62, but I don't care because my reverse mortgage will take my payment to zero. So it will become a part of your planning process. And when you go through it with 5, 10, 15, 62 plus year olds, then it will all start making sense and it'll be part of your overall planning. For example, my advisor in Wisconsin never goes into one plan without talking about a reverse mortgage, whether the people are 45 or 85, because that's the end result. Hey, you're going to do a reverse mortgage, so your payment will go to zero. But real quickly for you, Emily and Alex, if you take a look at the 5 major things, this is the main 5 things that we help with the most. We mitigate the sequence of return risks so people can keep more money in their investments. We control the IRMA because we control the taxable income, the Roth conversions, and the biggest thing is simply the non-taxable source of retirement cash flow and then stacking the tax deductions that I had showed to you earlier.
Mhm.
And the Roth conversions are a huge thing. Here's the sequence of returns risks that we can go through in more detail. And then the really cool thing is when we're doing the Roth conversions, you can see here, I'll have $600,000 worth of tax deductions by the time I get to 79. So I'll literally be able to convert somewhere in the neighborhood of 2.4 million without worrying about paying the full taxes on it. So those are the things that what I can also do if I've got a line of credit there, I can use that money. I worked with Ed Slott specifically on this, where we did the Roth conversions and being able to pull the money out of the house to make the Roth conversion tax payment. I got clients that are doing that right now, and in April we'll pay the taxes out of their house. So the whole $1 million that they're moving from the traditional to the Roth all goes into the Roth because we're going to pay the 300,000 in taxes. And they'll probably do it over 2 years. I think the advisor is planning, but I'll leave that up to them as to how quickly they're going to do that. So lots of tax strategies that you'll have a lot of fun with, Emily.
Yeah,
And,
that's
and I'm
my
sure there
specialty.
will be more follow-up questions. We're happy to continue to take them. They can be ongoing on case-by-case studies. We have a few more minutes to take a couple simple now. I do want to make sure I promised, particularly Alex, you're a little younger. I'd imagine a lot of your clients are probably more in the first-time home buyer bucket than in the retiree bucket.
So by the way, when you live in Tampa, I'm a young person in Tampa. Everybody's
It's fair. That's fair. Well, what I was going to say is this in terms of using this, I promised that we would be able to use this for some prospecting too. There is nothing wrong with calling your client who just had a kid and saying, congratulations on your newborn. That's so exciting. We're very happy for you. Life's going to change a lot. Where are your parents living? And hopefully you have family in the area that can help you. If their answer is, oh, my parents live in Connecticut and we're down in Florida, but they hope to retire and come down here someday. They just can't afford to live close to us. Well, maybe they can. And those are questions, again, that now you're not only solving a problem for your client, but you're solving a problem for your client's family and getting a new client out of it by simply solving a problem that nobody thought to ask. So that there are some prospecting strategies to using some of these tools that can help you grow your client base as well.
No, of course. Yeah, I've definitely been thinking about that. Do you mind if I run this case by you real quick? So the reason I was asking flood zone questions, I have a client that's on a street that had a couple houses that flooded. So that's where that came from. This guy is about 64. His house is worth I believe it's entirely paid off. I think it's worth probably 4-ish million, I think maybe 4.5. He's recently divorced as of 2 years ago, and he took a lot of the illiquid assets, more, I'd say a lot of the small business stock, things like that are very illiquid. So the guy is I'd say pretty cash poor right now, but he's probably a year or so out of a liquidity event, and the business he's running, all sorts of different things like that. Um, his son is kind of pinging all over the place, not really sure if he wants to have the house from an estate planning standpoint. Is this was effectively a extremely suitable case that you'd be looking for, right?
Without question, because to have four and a
Yeah.
half million dollars of assets in one stock, one real estate stock, is
Yeah.
not safe. It's not a good idea.
No,
Um,
and part of it too is security, right? I mean, there's somebody that was too. This guy's he loves cars. I think he has a couple electric plug-in hybrids. Two houses down from him, there's a house that completely burned to the ground because they left their Tesla plugged in.
Yeah.
And I mean, the whole family was home like while this happened, and there were actually 4 or 5 different house fires of the sort, and I think there was a casualty out of it.
there's one just north of us on Clearwater Beach.
Yeah, yeah, no, and you guys got it terribly with all the sand all over the roads and everything. It was a nightmare. But yeah, so with all of this going on, I just wanted to make sure that there's no like, catastrophe provisions because the son is just finishing up college. This kid's not gonna, let's say he were to pass, something were to happen, and let's say he wanted to keep it, you know, dumping a $4 million or $2 million liability on a kid is life ruining, right? So that's where that comes from.
Yeah, that would have been the wisest thing you can do is create liquidity for anywhere from 40 to 60% of the value of your house, somewhere around half, and that's certainly what could be done in that situation. We go up to $8 million houses, so and accept up to 12. But up to $8 million houses is fine. That fits into the program. So thank you, Jason, for putting this together, and I'll make sure I get the emails out to you guys and appreciate it. We'll do what we can to make a difference for your clients and for your firm. Generally, firms have an increase of AUM and or target premium about 30% when they implement this. So it's kind of a better deal for you than us sometimes, but we're glad to help.